Investing into dividends could be a great way to earn a passive income while having your investments grow over time, but depending on your position and how you invest, they could be causing you to miss out on significant gains. Because of that, I've dedicated this entire video to explain the reality of dividend investing, to first understanding why investors love dividends, the myths that people believe, the hidden cost of dividends, and then I'll end with my final thoughts to take forward. Knowing that, my name is Sully, and while this is not financial advice and you have to make your own financial decisions, if you do find value in this video, all I ask is that you consider hitting the like and subscribe button for future content like this. With that said, let's get straight to understanding why investors love dividends. Now, for those that don't fully understand what a dividend is, dividends are a payment that a company gives to its shareholders that allow investors like you and I the ability to earn a passive income with the potential to also see growth along the investment. And so companies offer dividends to attract new investors and keep existing ones to owning their stock, where many of the strong dividend paying companies are viewed as mature businesses with consistent profits. Examples of popular dividend paying companies include Pepsi with close to a 4% dividend yield, or ExxonMobil that is just over 3.5%. But something I personally like more when it comes to heavily investing in the stock market is to purchase an index fund, which is pretty much a way to invest into numerous stocks that track a particular market, all within one purchase. For this case, it would be for dividend paying stocks. By doing this, it reduces the downside risk of having to pick the right companies, and one of my favorites is the ETF through Charles Schwab with the ticker of SCHD that contains 100 of the strongest dividend paying companies and has even averaged a 3.87% of a dividend yield over the past 12 months. Not just that, but many dividend investors love how many of the publicly traded US based companies and strong dividend funds like SCHD could be treated as qualified dividends, which means that the dividends you earn could be taxed in the long-term capital gains tax bracket, which is taxed at 0, 15, or 20%, which is much lower than the ordinary income tax rate. Now, a dividend is considered qualified if you own the stock for at least 61 days out of a 121-day holding period that begins 60 days before the ex-dividend date. All in all, if you just hold your investment long enough, you'll reap better tax rates on the income you get from dividends. And so to see the actual amount considered for SCHD and other Schwab ETFs, simply search something like SCHD qualified dividends, and one of the first pages will show you a list of specific ones and what percentage of the income you earn that can be treated as qualified income. But as far as the total income with SCHD, let's say that you had $10,000 invested for the past year. That means that you would have received a total of $387 in passive income, which might not sound like much, but say you built it up to $100,000 in SCHD, that would be close to $4,000 in passive income throughout the year, which is close to an extra $1,000 every quarter, which is every 3 months. And depending on your tax bracket and if you've held the investment long enough, with qualified dividends, you may not have even been taxed on the income at all. Of course, that's not enough to live off of, but the main concept investors love about dividends is that you are investing into a more stable company that also gives you flexibility with a cash flow coming in on a recurring basis. But aside from the income standpoint, SCHD on average has appreciated in value very well, where you can see with dividends being reinvested back into the fund, it would have achieved an average of just over 11% per year over the past 10 years. So whether you look at a fund like SCHD that contains strong dividend paying companies all in one purchase, or you pick the right companies like ExxonMobil that have grown very well and provide a nice income, dividends can be a great choice for many investors, but I would proceed with caution and fully understand the reasons for why you are buying them and the downsides prior to making any decisions. Because of that, let's now go over the myths that people believe about dividends. And so the first myth that many believe is that dividends are always a safer investment, but in reality, many dividend stocks contain high risk and may very well struggle to see strong underlying growth for the business. So if you are trying to pick individual companies, just understand that the future is always uncertain. For example, many of you have probably heard of or have seen the company UPS constantly delivering products all over the roads that makes them very credible, which they are a large corporation valued around $75 billion. But just because they are a credible company paying a strong dividend yield, it doesn't mean they are a good and safe overall investment. In fact, the value of UPS's stock over the past 5 years was nearly cut in half, and this is going to lead me into the next myth, that is, a high dividend yield is is a better investment. You see, typically companies that pay a high dividend yield, like many over 5 to 6%, may very well be unstable companies, and the high dividend yield could actually have been due to a fast decline in the stock's price, and for many, this can cause what's called a dividend trap. Crazy enough, if you bought UPS's stock at the beginning of 2020 and reinvested all of the dividend income that you received, you would have still averaged close to a negative 2% per year. And even a high-paying dividend ETF like DIV that is reported to have a 6.7% dividend yield over the past 12 months, looking at its recent performance over the past 10 years, with dividends being reinvested into the fund, you would have averaged just under 3% per year. If you took the dividends as income, that means your investment would have actually gone down in value. So when it comes to dividends, be aware that the high yields you see may seem like a nice income, but many times they are a riskier investment. The next myth, number 3, is that dividends may be viewed as free money, but in reality, they're coming from the company's profits that would otherwise have been used to fuel the company's growth, which many times the share price of a stock usually drops by the amount of the dividend after the ex-dividend date. So dividends are not free money because they're pretty much reflected on your own investment regardless. Following that, the next myth, number 4, is that dividend stocks outperform growth stocks. While some dividend stocks have definitely outperformed some growth stocks, on average, because growth stocks typically don't pay much in dividends or at all, and if they do, it's very low, like Apple being at 0.45%. But the reason they are called growth stocks and typically outperform is because they use the profits they earn to reinvest them back into the business for further growth. So because I'm a huge index fund investor and create a ton of content on them, 2 of the most popular Charles Schwab ETFs that I personally like are the Schwab US Large Cap Growth ETF with the ticker of SCHG and the Schwab US Dividend Equity SCHD that I mentioned earlier. And so with dividends being reinvested for each, over the past 10 years, SCHG would have averaged roughly an 18% annual return when compared to SCHD that was just around 11%. This means an initial $10,000 in SCHG would now be worth roughly $50,000, where SCHD would be $28,000, and that includes the dividends being reinvested and is a huge difference. Now, dividends definitely have their time and place for investors, but it's crucial to understand the hidden cost when investing into them. To start this off, understand that dividends are not always guaranteed and they can be cut at any time, typically in economic downturns or when a company is specifically going through financial stress. In fact, a popular example of this is from Walgreens, who recently suspended their dividends, breaking a 90-year plus streak of shareholder payouts. And if we look at the dividend history, you can see that in early 2024, they cut their dividend by nearly 50%. So if you heavily invested into Walgreens stock, this could have a huge impact for you, but if you purchased a fund with many different stocks in one purchase, the risk would be minimal. But aside from the fact that dividend stocks typically underperform growth stocks, another fact that personally pushes me away from dividend investing right now is the tax drag that can be forced on an investment portfolio. You see, regardless on if you reinvest dividends or not, they are going to trigger taxes to you. And yes, if they are qualified dividends and you are under a certain income threshold, you can get much better tax rates, but depending on your position and how you invest, dividends could actually prevent your investments from growing much stronger and faster, especially if you are investing for the long term. To give you real world examples, let's start by saying that you are a single filer who has an income of $80,000 per year. We're going to ignore state tax to keep things simple, but all that means is that any ordinary income generated would be triggered at the 22% tax rate, and then for qualified dividends in the long-term capital gains tax bracket, that would be taxed at 15%. So to test things out, let's say that you had $100,000 invested into a high dividend paying ETF like JPI that, let's say, averages an 8% dividend yield, and then you had another $100,000 in SCHD, and let's just say it averages about 4% of a dividend yield to keep things simple. Then let's say you put $100,000 into the S&P 500 index fund like VOO, which currently has roughly a 1.2% dividend yield, and then a large cap growth fund like SCHG with a 0.4% dividend yield. Now for JPI, because the fund uses hedging strategies to generate the income, roughly 80% of the income you are going to be earned is going to be triggered and taxed at your ordinary income, with the rest of the 20% being qualified dividends. So if you earn $8,000 in dividend income in the first year with JPI, from your $100,000 investment, that means you would have to pay a blended tax rate of just over 20% on your income, which results in over a $1,600 tax bill triggered from your investment in JPI, whether you reinvest the dividends or not. But the most important part to understand here is that that tax bill creates what's called a tax drag because it is a burden on you. And if we divide that amount by your original investment, that means that JPI would actually cause you to have a 1.65% tax drag. And if you were to have a high tax drag like this year over year for many years, it could easily cost nearly anyone watching this hundreds of thousands of dollars over time. Now, if the $100,000 were an SCHD, you would have earned $4,000 from dividends in the year, and being solely qualified dividends, that means you would pay 15% of tax on the $4,000 of income, which is $600 triggered in taxes that you'd have to pay regardless on if you reinvested the dividends or not. All in all, that creates a 0.6% tax drag, which is much better than JPI, but it is still a tax burden that you have to pay at the end of the year. Where if that were $100,000 in solely an S&P 500 index fund, you would have earned $1,200 in income, and with that being qualified dividends, that would cost you $180 in taxes, which is a 0.18% tax drag. And lastly, if you went all in on growth with a fund like SCHG, you would have earned $400 in income, and being qualified dividends, that would cost you $60 in taxes, being a 0.0% tax drag. So just realize that the higher the dividend income that you earn, the more likely you are to have to pay higher taxes, and if you are invested for the long term, this can seriously eat away at your potential growth. Not to mention, but looking over the past few years since JPI came to the market in 2021, a side-by-side comparison shows that SCHG would have achieved a 15.3% annual return. SCHD, the strong dividend ETF, would have been 8.2%, JPI with the high dividend income would have been 8.1%, and VOO would have generated 13.6% per year of growth. Understand that the data here includes dividends being reinvested into the fund, but does not factor in the tax cost I just mentioned that would be triggered. And so the true after-tax returns you'd see with an investment like JPI would be even lower, easily being the lowest of the four options. So knowing this reality of dividend investing, here are my final thoughts to take forward. To start this off, understand that the choice truly comes down to your personal preferences and what you want. Many people, no matter the age, actually love dividends because of the psychological aspect of knowing money is consistently coming in. Now, of course, my viewpoint may be different than yours, but I truly believe if you are one looking to invest for the long term and grow your investments as strong as you can, that growth stocks are the all-around better option, especially in the early years. Which I do believe that diversification is crucial when investing, but because growth stocks pay low or even no dividends, they use their profits to reinvest back into their business for further growth. Historically, they have proven stronger returns for investors, and there is a significant lower tax drag on your portfolio over time. For me, investing for many more years to come and not needing a passive income right now or anytime in the near future, I see dividends as something just slowing down the growth of my investments. Like I said, everyone has a different position that they're in, and the choice is completely up to you, because if you're one eager to live off of a dividend income before the standard retirement age, dividends may be very intriguing to you. But personally, my plan is to maximize the growth now in tax-advantaged accounts like the Roth IRA, to later on transition into more dividend paying stocks so that at retirement, no matter what dividend investments you choose, even the high income producing one like JPI, the tax drag won't matter and you can have a complete tax-free dividend income at retirement to last the rest of your life. If you want to see more on that, I've made an entire video that I think you may find great value from, and I'll also have other resources that I've created linked in the description below. Not to mention, but if you want to get started with a new investing platform, I'll also have a direct link to some of my favorite ones below, which depending on the one you choose, I may earn a commission for it, which is greatly appreciated. And as always, don't forget to hit the like, subscribe, and notifications button for future content like this.